Hi, this is Matthew Cratter from Trader University, and today I want to talk to you about a strategy from my book, Day Trading Made Easy, which is available on Amazon. Now, this basic strategy involves looking for stocks that are reporting bad earnings, negative news in their earnings. So, for example, on August 31st, just last week, Campbell Soup reported that their fiscal 2018 was going to be very difficult. Now, if we take a look at the stock chart, what happened? This is a chart of 15-minute candlestick bars of Campbell Soup. And you can see right over here is where they reported earnings. So they reported earnings before the market opened on August 31st, and the stock gapped way down. So the basic setup is you want stocks that are reporting negative news, and you want to make sure that the stock is gapping down below its lowest low of the last 20 days. And you can see that's true for this stock. So then that's the basic setup. What you do then is you wait for the market to open and trade for 15 minutes. So you want to look at this first 15-minute bar here. Let me just scroll in a little bit. So you can see the market gap down right to here and then rallied for the first 15 minutes, but still stayed below the low of the last 20 days. So what you do in this case is you go short at this price, the closing price of the first 15 minutes of the day, which in this case was 48.07. So you wait 15 minutes, put in a limit order of that price. You can see on the second bar we would have gotten filled right at 48.07 because it traded as high as 48.29. And then what you do is you just hold on to that short for the rest of the day and you cover right before the market closes. So in this case, we would have covered right at 46.25. Now, in many cases, when a stock reports negative earnings like this, it'll continue to sell off for multiple days. So if you wanted to turn this day trade into a swing trade, you could have actually held on for another trading day. And then you can see it's actually started trading higher. But this was good for at least a two-day trade. Now, if we went short at 48.07 and covered at 46.25, we would have captured 1.82 points. And on 500 shares, that would have been $910. So not bad for a one day's work of trading. The one thing I forgot to mention is that when you go short at this price here, at the closing price of the first 15-minute bar, you want to use the high of this bar, of this first 15-minute bar, as your stop loss. In this case, that high was 48.38. And so if the stock were to trade above that during the day, you'd want to exit your short because sometimes the stock will mysteriously rally even on bad news. And so that's how you protect yourself. But the basic strategy is to benefit from this downward momentum. And usually when a stock gaps down like this, people are afraid to go short because they think, wow, it's fallen 20% already. How could it ever fall more? And then, of course, as the longs exit their position, it keeps selling off. That's the basic strategy. If you want to learn more, check out my book on Amazon, Day Trading Made Easy, or go to trader.university, www.trader.university. And I'll put all the links in the show notes below, in the description notes. Thanks for listening, and I'll see you in the next video.